I'm Anzulaki. What's your name?
Yeah.
Okay, so here we start. I just wanted to ask you that can you please explain me the accounting process and one of the accounting principles maybe?
The accounting
Oh,
process.
Joe, just wait. I'll tell you the accounting process and you can go on with the accounting principles, right? So the accounting process is divided into 7 parts, and the first part is identifying the documents and the transactions. You basically combine all the source documents like purchase orders, loan agreements, and invoices. After that, what you do is you record the transactions. That's one of the main parts. You record the transactions. You make it into a general journal, and then you post the entries into an individual accounts, which is the T ledgers. T ledgers are more like ledger accounts of separate entities or separate different debtors and creditors and their liability accounts, and it's basically a combination of different elements of the accounting, right? So the third one is post the entry. The entries they need to be posted into different ledgers, and after that you have to make a report, which is you combine all the balances of the ledgers into a trial balance, where the debit side has to equal the credit side, and if it does not, if it does not balance, then that means there's an issue with the accounting ledgers, right? The fifth one is you have to make adjustments if the trial balance does not balance off. If it does not balance off, you have to make adjustments. These adjustments can be depreciation. You do know what depreciation is, right? Yeah, that's really cool. Because you need to record depreciation periodically, and you have to do it for all the equipment and the assets you have. The second last one is you basically combine the reports into one single report, which is the balance sheet. You make it in order to you actually make the reports so that the stakeholders of the business can use the data in it to to make investment plans in the future and make important decisions. So that's why that's the accounting process. So can you please tell me the principle, any one principle?
So I'll talk about the entity principle.
Okay.
It states that the business is a separate legal entity from its owner. So the
Oh, I
assets.
see. Okay. Okay, go on. Go on. Why are you laughing? Come on, go on. Come on, go on. What the hell? No, we're gonna edit that. Okay. Yamuna, can you please tell me the accounting principle now? Can you please explain me the accounting principle?
The accounting entity principle states that the business is a separate legal entity from its owner.
All right.
Which means that the assets of the business and the property owned by the owner will not be considered as non-liable.
Okay, so can you please explain me the accounting principle maybe?
The accounting entity principle states that the business is separate from its owner.
Oh,
So
right.
assets of business and property owned by the owner is considered to be separate.
Ah, okay.
So liability is also separate.
Okay.
In this way, we only record property that is owned by the business and not by the owner in the financial reports.
Okay.
For instance, according to this principle, the owner can be sued, but this will not affect the business.
That actually means that the owner, if for example the business gets into maybe some issue with some legal matters, so that means the business cannot be sued. The business will be sued, the owner will not be sued.
Yeah.
That's what you mean. Oh, that's good. Yeah. Keep going on. Yes. Keep going on. Come on. Hi, how are you? I'm Mansur.
Fine, I'm Tan Dishan.
Oh, nice to meet you.
Nice
So here we start again. So the thing is that can you please tell me the accounting elements?
Accounting consists of five basic elements, which is asset, liability, honor, equity, revenue, and expenses, and which two will be affected at the same time by a single transaction. Assets are resources controlled by the entity and will provide future inflow of economy benefits, whereas liability are present obligation of the business arising from past transaction, which will result in a future outflow.
Oh, alright.
A situation which would affect both of these elements would be, were suppose a business is purchasing machine on credit from a supplier. This would increase asset and increase liability to the business in the form of debt owing. Thank you.
Oh, thank you so much. Hello, nice to meet you.
Nice to meet you.
What's your name?
Zen.
Oh, alright. So can you please explain me the qualitative characteristics of account?
The first qualitative characteristic is relevance. Relevancy is a qualitative characteristic of accounting which will help the business to include information related and useful for accounts. Also, the entity principle is related to the qualitative characteristic of reliability, as the information extracted from the financial documents will be accurate, as we only record transactions related to the business. Reports should also include relevant information that is useful for decision making and exclude information that is not. Actually, this sums up the next accounting characteristic, which is reliability. Financial reports are reliable if information provided is free from bias, verifiable, and accurate.
Bro, you want this?
No, thank you.
Oh, alright. Thank you.